Good morning from London. This is Bloomberg Markets Today. I'm Guy Johnson alongside Tom Mackenzie. Anna and Critty are both out today. Got about an hour until we start trading here in Europe. So what do you need to know this Friday morning? It is payroll day in the USA. The key jobs data expected to show a slowing in the US labour market. But will that be enough to keep this week's big bond rally on track? The ECB cuts but keeps the market guessing about when it will do so again. We'll talk about that story in detail. And Macron sends Mirages to Ukraine. The enhanced military support comes as Volodymyr Zelensky prepares to address the French National Assembly. We'll bring you that. Plus, he's going to be meeting with Joe Biden in Paris a little bit later today, Tom.
Non-farm payrolls, as you say, the key data point of the day as we check in on these markets. Why would you be putting on massive bets ahead of that data? So a bit of a holding position coming through, at least being flagged by European futures. But if we end the day where we are right now, it will be a pretty decent week so far for European stocks. Futures currently flat, FTSE 100 looking to modest gains of 0.2%. The US 10-year at that 430 level. Let's see how much volatility there is around that on the non-farm payrolls data. The estimates of 180,000, euro dollar at 108. A bit of strength that came through yesterday on the back of the decision. Currently not moving, 108 on the single currency. Markets today starts right now.
We are not pre-committing to a particular rate path. We will continue to follow a data-dependent and meeting-by-meeting approach to determining the appropriate level and duration of restriction. In particular, our interest rate decision will be based on our assessment of the inflation outlook in light of the incoming economic and financial data.
Friday the 7th of June. Good morning, folks. Let's talk about what Christine Lagarde had to say yesterday. I thought it was fascinating, Tom. Up until now, she's put her cards on the table. We are going to cut in June. That is going to be the story. Now she wants to play poker.
Well, as the one standout, the one member who decided not to vote for a cut, Holtzman said, if you're data dependent, then be data dependent. They haven't been. They were forecasting this arguably pretty clearly from January, February of this year, the June cut. Now they are saying they're data dependent. It seems like July is being ruled out. That was the Bloomberg reporting, having spoken to many members of the ECB after that decision. So is September still in play? And what does this mean in terms of the adjustments coming through with the policy reaction?
Do you not think it's weird? So, as you say,
weird.
Beginning of the year, we're going to cut, we're going to cut, we're going to cut. June cut gets priced in, everybody's comfortable with it, and now they're like, don't know what we're going to do next. Is this a cutting cycle? Is this something that's going to sort of progress into 2, 3, 4, but maybe sort of cuts down the road? We don't know yet. She suddenly wants to play poker with the market, and I wonder why. You look at the data, you can understand why she wants to do that. Because at the moment, I think the data really don't tell a clear story for the ECB, and that is a problem, because you want consistency in communication.
Well, cutting when you raise your inflation forecasts for this year and next, there's something unusual in that. So how much uncertainty does this inject into the way that the markets now interpret this ECB as we look to expectations going forward? Venram of MLive saying, in terms of the terminal rate, as you project into 2025, you can't get below 270 for this ECB. That's his take, given where we sit on the neutral rate for the European Central Bank. I thought that was interesting. But the uncertainty, it seems, is now back in play for this ECB, having had this clear guidance up until June. OK, let's bring Lizzie Burden in. She's in Frankfurt. She's been covering the story for us. Lizzie, why does Christine Lagarde now want to play poker?
Because it's such a confusing time, evidently, Guy. Look, she was wearing a necklace, if you squinted, that said "in charge," but there was a palpable sense of disarray, both around the decision and the path ahead. As you say, they've decided to cut rates and raise their inflation forecast both for this year and next year. You had some economists saying that this was a data-independent cut. That was the SocGen line. And yeah, Robert Holtzman, the Austrian, was the only one who felt confident enough to point to that recent economic data, the sticky inflation, the rapid wage growth, and say that actually they can't go with what they had telegraphed, perhaps over-telegraphed, with that June cut. Lagarde's response was that data recently is a bump in the road. There'll probably be more bumps in the road, but they are moving in the direction that is appropriate. And in her defence, the IMF said it was the right time to cut, Guy.
Lizzie, is it your take then that it is right to completely sideline completely sidelined July? Because up until the decision in June, we had heard from some of the more dovish members suggesting we shouldn't rule out July. But has that debate now been closed down by the data, the revisions higher? And to what extent is September still live for this ECB?
Well, it seems to have been closed down by most of the governing council, all but closed down. We've just had some fresh commentary from the Latvian Martin Kazaks, echoing Christine Lagarde's commentary yesterday, saying that the fight against inflation isn't over yet. They've got to take gradual steps going forward. They've got to be data dependent. So very much aligning what she said. Lagarde saying that she's not pre-committing to a particular rate path. She's not wanting to confirm that they're in a dialing back phase. That was Bloomberg's question at the press conference. So where does it leave the market? Well, you've got traders still reckoning that there will be more cuts this year, but the timing very much up in the air. They had thought there would be 2 more moves this year. Now it looks more like 1. And we've got a Bloomberg scoop that policymakers are questioning September as well.
That's amazing, considering we've just had a cut and now we're waiting potentially beyond September. Lizzie, this cut looks quite isolated now in terms of it standing within a wider cycle. And I'm wondering, therefore, what this means for the European economy. There has been this expectation that a cutting cycle would give a boost to that economy. That had been baked in. If we start to withdraw that stimulus, what does the European economy's trajectory now look like, given potentially a tighter policy path from the ECB?
Well, don't forget, Guy, that as well as upgrading the inflation forecast for this year and next, they also upgraded the growth forecast for this year. So that's a boost for cyclical stocks. Yesterday, you saw this rise in European equities actually to a near all-time high, even though the cut yesterday was well telegraphed and well priced. So some of the winners yesterday, banks and healthcare, some of the laggards yesterday, real estate and utilities. And more broadly, actually, you had Bank of America saying this could be the boost that was needed before the summer lull to get a bit more of the IPO action on the table before we take a summer break.
OK, Bloomberg's Lizzie Burden in Frankfurt, of course, covering all the ECB action for us out of Frankfurt, and the reaction to that and the implications, of course, for these equity markets that so far this week have had a pretty decent run across European stocks. Here's what else to watch out for then today. Of course, 1:30 p.m. it is the big one. It is the US jobs report. Forecast is expecting the US the employment report for May, adding to new evidence that the labour market is gradually cooling. The estimates are around 180,000, with the jobless rate coming at 3.9%. That's the estimates. Today, voting continuing in the elections for the European Parliament. 4 days, of course, 27-country ballot to select MEPs. And throughout the day, the ECB Governing Council members are speaking, including Schnabel, Centino, Holtzman, and the ECB President Christine Lagarde later, 3:15 p.m. UK time. Maybe they can add some clarity to the current lack of clarity in terms of where the ECB goes next. But, of course, it is all about the jobs and the print of 180,000. Really interesting that the Bureau of Labour Statistics has come out with some more recent data suggesting that you could see you may need to mark down last month, on average, by about 60,000. So whether or not you're writing that off.
Well, I don't think it changes the overall picture, which is of a clearly strong labour market. Maybe it's a little bit weaker. Are we not seeing
cracks in this?
No, I think in the past. So this is you're talking about the BLS data, which is historical, OK?
True.
So that's the rearview mirror. Yeah. The US economy is doing really well. There are other data that support that idea. So yes, the labour market may not have been quite as strong as we anticipated it was, but it was still strong. So I think yes, we can tweak the data.
Yeah.
Today's number, I think, is really interesting. So 180 is the survey number.
Yes.
You can go on the Bloomberg terminal, and there's a fantastic function, WHIS, whisper number, and that's got it at 166. So the market over the last few days, and you can see the trajectory of this, has been over the last few days marking lower the expectation. So we're going into this with an expectation of a weaker number, and that is consistent with what we've seen in the bond markets. The yields have come down quite sharply this week. So we're going in with a dovish tilt to this data, with an anticipation of weaker than anticipated data. Therefore, is the risk, therefore, that actually the data comes in at 180,000 and we see a big reversal of this bond market trade that we've seen this week.
And where the 10-year currently at 4.30 goes from there. Where the 166, then, if that's the whisper number, does that support the equity markets? To what extent is that priced in at this point?
This is really difficult. So this is the head scratcher for me constantly. Is good news bad news, or is bad news bad news. This is the kind of the debate that goes round and round in circles. And in theory, a good economy should be good for the consumer, and watch the wage number should be good for the economy and therefore should be good for equities. However, the equity market is very concentrated, and as a result of which, if you put this together, a weakening economy with what is happening with rates, I don't know. It's a really tricky one to call.
Yeah, if this is a Fed that cuts on the back of slowing inflation, good news for equities, arguably. If it cuts because the economy is weakening substantially,
That's a different picture.
Bad news for earnings. And you're right to zero in on the wage earnings component, of course, within the jobs data mix. Interestingly, we got a piece out, of course, on the likes of Citi and JP Morgan being amongst the only banks, the last few remaining, who still expect to cut in July.
I find this absolutely stunning.
140,000.
I find this absolutely stunning, considering basically a whole load of Fed speakers have come out. Well, a whole load of them have come out and basically said we need to see a series of data. We need to see a series of months of consistent data which will allow us to cut. I'm assuming that's more than one. So let's say that takes us through the summer. That puts us at least at the earliest at September. So I'm quite surprised that we're still where we are. With these calls. OK, there's the pushback. Guy Johnson versus Citi and JP and JP Morgan. We've got some lines in terms of what is happening on the geopolitics then. We know that Emmanuel Macron is pledging to send these fighter jets to Ukraine, also planning to, of course, train the pilots. This is part of conversations. We know as well that Biden and Macron and Zelensky are going to be meeting later at the G7. I wonder to what extent this moves the dial in terms of European support for Ukraine. He doesn't think the aircraft are going to be able to get there, the Mirage, until the end of this year because they need to train the pilots. They're about to get the F-16s. OK. Which they've been... With the pilots. They've been training the pilots. There's been a whole sort of training programme that's been on in terms of the F-16s. That's about to happen. This will happen a little bit later. And these are 2000. These are the air-to-air version of the 2000. And basically, I think this is designed basically to deal with the threat that Russian bombers are posing in terms of the aerial bombardment. But it does, again, just... And these are aircraft that are being phased out of the French military. But again, just raises this question about where is Europe's defence going? How much money is Europe ultimately going to have to spend to bolster its own defences? Yes, they're phasing out these 2000s. Yes, they're going to be going. But does that mean that the French are going to be buying more Rafales from Dassault? Does that mean that other countries in Europe are going to be buying more aircraft elsewhere, potentially from the United States? How does Europe keep this within Europe? Do you buy the Eurofighter? Do you buy more Rafales if you're going to be bulking up your air defence systems? I don't know. It speaks to the wider challenge that Europe has of rearming and how much money that costs. And I think this is just emblematic of that. Here are some older aircraft. We've now got to buy newer ones. And Macron has been leading on both of those issues, or at least pushing on both of those issues, which is buy in Europe, make in Europe, buy in Europe, but also has been taking arguably a more assertive role in terms of how far NATO and European allies should be getting in terms of that support for Ukraine and causing some pushback from some quarters on that. He was asked in this interview as to whether or not it would be seen as a sign of aggression to be training Ukrainian troops in the western parts of Ukraine. And, of course, his response was absolutely not. This isn't the western part of Ukraine. There's no Russian military presence there. It's a training facility. But you can see the lines moving as Europe and NATO looks at their options, their toolkit, in terms of trying to push back against a Russia that's been on the front foot in the recent months. Yeah. I still come back to this is an industrial story for Europe and how Europe rearms, how it gets its industrial military machine lined up. I think it's going to be really interesting. So Zelensky's going to be addressing the French National Parliament, the French National Assembly, the end of the next hour. We'll try and bring you some of those comments as that happens. And, of course, all of this tying in the defence industrial capacity of Europe, a big part of the conversation, a big part of the debate amongst political parties in Europe. We're going to discuss the future of European policy on these issues as 27 nations, of course, vote in those EU elections. Don't miss our interview with Marcus Beira, Business Europe Director General. That's at 8:30 a.m. UK time. Plus, this is fascinating, UK tech tycoon Mike Lynch cleared of charges that he pulled off Silicon Valley's biggest ever fraud 13 years ago. We have the details later in the show. If you have any questions of your own for our guests, please send them to us on IB plus BBTV Go. This is Bloomberg.
Are we today moving into a dialing back phase? I wouldn't volunteer that because, as I said, we are making a decision on the basis of the confidence that we have that we are on a path. We know it's going to be a bumpy road, let's face it. The next few months will continue to be bumpy.
It's going to be bumpy. Christine Lagarde committed, the ECB committed, beginning of this year, to the rate cut we saw delivered yesterday. Now she's got a poker face on. And I think that is really interesting in terms of kind of where we go next. They don't know, and it's really clear that they don't know yet. They've raised the short-term forecast on inflation for this year and next. Where does that take policy at the ECB? And is this really the start of a rate-cutting cycle? Konstantin Fit, the portfolio manager for European rates at PIMCO, joins us now. Nice to see you. What did you make of it yesterday? You got a pre-commitment to a rate cut. That gets delivered, but then the message is it's going to get bumpy and we don't know. What do I make of the ECB's communication here?
I can see where they are coming from. Inflation has been at 2.6%. At the peak, we are now between 2 and 3, which is obviously way more reasonable. And according to the projections, you are getting there at the end of next year. So I can see why you slowly want to think about removing restrictiveness. Yeah. And I think anything above 3% for the ECB is clearly restrictive, so they're not normalizing policy, they're just shaving off a little bit of the restrictiveness. So I think I can see where they're coming from and why they decided to cut rates. But obviously, given the data recently, it wasn't a straightforward one.
But how isolated is this cut going to end up looking? Like if it's September, it doesn't look that isolated. Anything beyond September, and this cut looks like it sticks out like a sore thumb. It feels like an anomaly rather than part of a bigger kind of trend shift. And how quickly do they need to make the next cut come in to make yesterday's cut look like it's part of a bigger, well-thought-out plan?
I don't think they're in a rush from here. It's perfectly fine to lower cruising altitude somewhat. So you go from 4 to 3.75. You're still restrictive. That's what policy needs to be. And then you just see how data comes in. So as long as they don't have to reverse course and hike rates again, I think that's perfectly fine. Yeah. If they have to reverse course, then it's obviously a bit of a problem.
How damaging would that be to markets? I mean, how dangerous is that? How much of a risk is that for this market? And in terms of, I guess, less a question about how to quantify that as a risk, more what would the market reaction be?
Not good.
In the case, I mean, how damaging would that be for market sentiment if you get to the point that inflation remains sticky, moves up, then naturally they have to push it back up to 4%?
Yeah, so that's a risk that's certainly not 100% priced in the financial market. So starting yields are high. Yeah. So I guess for fixed income and the risk-free complex, it's somewhat more digestible. But for the riskier segment of the investing universe, like equities, that's certainly a scenario that's not overly pleasant if, rate hikes come into sharper relief again. OK, so we're lowering the cruising altitude. For how long? Where does that take? You think there's another 2 cuts that come through this year. What derails that view? So our house view is broadly in line with the ECB in terms of the macroeconomic scenario. So we also see inflation normalizing towards target next year, and that should pave the way for more cuts and for reducing restrictiveness. There's a lot of risks out there. I mean, the staff projections not only assume that wage growth normalizes from 5 to 3 over the next 2 years, it also assumes productivity picks up again. It assumes that unit profits absorb much of the wage increases this year. So that all remains to be seen. But if that all plays out, then I think we will see 2 more cuts this year. And at the staff projection meeting, it's very unlikely that they cut in the non-projection meetings. German 10 years just north of 3, 2 years just north of 3, 10 years just kind of around 2.5. What do I do with that? What's the trade? What am I doing here? Yeah, so we are broadly neutral at these levels. So similar to the US, we see the range on the 10-year. In the US, it's probably between 4 and 5. In Germany, between 2 and 3. So at 250, plus minus, we are broadly neutral. So in duration, we technically like to be tactical and play the range. While on curve, the interest rate curves, we have a higher conviction, so we expect the back end of the curves to normalize. We think the curves are too inverted, and term premia will come back in over time. But that's probably also more a secular story. What does it do to Italy? What does it do to BTPs? What does it do if the ECB stays higher for longer? Where is the biggest threat to higher for longer in Europe in terms of the various Eurozone government bond markets? Where does that most manifest itself most clearly? Yeah, we all thought that the ECB raising rates as it has done could be a problem for Italy.
Yeah.
And we all thought, who will buy all these bonds? And we know the answer now is retail. And yields are high, yields are attractive, so we don't see any issues currently when it comes to the technical side. And the spread is at 125, which is pretty reasonable. That's not something where we want to be engaged. We are broadly neutral, the spread here as well. But we don't see the ECB staying higher for longer as being a problem for Italy.
Look, Guy's been hammering home the whole story around the defence industrial base in Europe. And that, of course, ties us to the fiscal spending story. Maybe not immediately, but longer term. I mean, it's certainly coming through in Germany. What kind of challenge does that pose to some of the sovereign debt markets, maybe around the periphery as well?
I agree that fiscal is a risk over the medium term. And while Europe aims to go back to the Stability and Growth Pact, has reformed the rules, we think there are risks around the ability to achieve the targets. So the risks to fiscal, in my mind, are to the upside. There's a lot that hasn't been done in the past, and there's a lot that needs to be done in the future. So I can see deficits, for example, overshooting the Commission's projections from...
The scale of the challenge, Tom, is absolutely enormous. You've got to do the energy trial. You say I bang on about it, but it is a bit of a daily thing.
It's not a critique.
Europe has to spend an awful lot of money. It's got to go through the green transition. It's got to rearm, and it's got to continue the welfare payments that it's got at the moment with an ageing population. These are with an already high debt load.
Do the risks reduce if you have a collective agreement on funding defence, for example? We're not there yet, but does that reduce some of those risks on the fiscal front?
That's not entirely obvious. So we have seen that the Next Generation EU, for example, was helpful from a signalling perspective. So that might be good. But overall, I think the stuff has to be paid for. And if you look at, for example, where the EU bonds are trading compared to individual countries, it's also not entirely obvious that this is a huge fiscal benefit for the member states. So it's not entirely obvious whether that solves the problem.
How does is the bond market still does the bond market still not know how this story progresses on the fiscal front? The challenges, as you say, it's got to be paid for, and the numbers could be absolutely enormous. How ready is the bond market? How priced is the bond market for the fact that over many years to come, Europe is going to have to be spending considerable amounts of money? I don't know what form it's going to come in. Is it national governments? Is it across Europe? But in terms of the back end of the curve, how much of this is already in, do you think?
I think that's not necessarily a European story. So remember September, October last year, where you had the bear steepening in the US, which drove up the other markets, the other jurisdictions, and we had the Liz Truss episode in the UK. So you have this flare up regularly in terms of fiscal concerns, which leads to a correction in bond yields. So this is something we expect to live with going forward, and which will remain prominent. And this is part of the reason why we think we are not particularly engaged in the long end of the interest rate curve and expect that to normalise over time.
I probably, when you told me that you're not interested in the long end of the curve, I should have probably already known the answer to the question you just gave me. Constantine, great to see you. Thanks for stopping by to see us. Constantine Wiebe, the portfolio manager, European rates over at PIMCO. Coming up, we're going to continue this conversation. President Macron planning to send fighter jets, the 2000s, to Ukraine. He's going to be training Ukrainian troops as well. Will that be enough to shore up Kyiv's defences as Russia's war against that country drags on into its third year? We'll talk more about this next. What signal does it also send about Europe's desire to continue to rearm? We'll talk about that next too. This is Bloomberg. Payroll's day in America. That's the big trade today. We're waiting for that number to drop. 1:30 UK time is when we're going to be getting that figure. Friday the 7th of June. That story is likely to dominate from a market point of view. The headline number, the survey number, expected at 180. But actually, if you look at the whisper number on your Bloomberg terminal, that'll tell you actually the number the market's expecting is a little lower than that. Is there therefore the potential for an upside surprise to this figure, which will confound this bond market rally we've seen this week? Let's take a look at futures, show you what is happening so far this morning. This is the picture we have going into that payroll number here in Europe. As you can see, a little bit of an unch feel about this morning. We are waiting for that data to be delivered a little bit later on. That will be the catalyst that I think the market looks for this Friday. Do not ignore, though, the TSMC data, which we had a little bit earlier on. We'll come back to that. Tom's keen to talk about it. Let's turn now, though, to what is happening with the war related to the war in Ukraine and Europe's response to it. President Emmanuel Macron says France will send fighter jets, the Mirage 2000, to Kyiv and train thousands of soldiers to help the country repel and continue to repel the Russian invasion.
We will launch a new cooperation and announce the transfer of Mirage 2005 French fighter jets that will allow Ukraine to protect its soil, its airspace, and as early as tomorrow we will start a pilot training program and transfer of planes.
The French president speaking on French television last night. Let's delve into the details of what we've actually learnt here. We're joined now by Bloomberg News Director for EMEA, Rosalind Matheson. Ros, thanks very much indeed for joining us. Look, let's talk about what this signals. These are relatively old aircraft that they're sending. We've had the meeting also, though, in Normandy. Are we seeing a new phase in terms of Europe's desire to rearm or continue to rearm Ukraine?
Well, it was an announcement. Obviously, Macron felt he had to say something with the Ukrainian president there for those commemorations yesterday. Yep. And so you get the announcement, as you say, like old aircraft, you've got to train the Ukrainian pilots to fly them. He's talking about possibly getting them there at the end of the year. So presuming, obviously, from his statement, he thinks the war will still be going on. Yep. Potentially at the end of the year, but also these are not going to be arriving immediately. And so it's that signal of we want to still show we're supporting Ukraine, but they're really running low on options in terms of the military support in particular. So do they now send instructors to train Ukrainian soldiers directly in Ukraine? On the quiet, they've probably already been doing that since the war happened. Are they now allowing, Western-made missiles or weapons to be used to strike inside Russia in very targeted ways? It's all that kind of inching of support without provoking Vladimir Putin too far. Well, that's been their concern, but there's still that underlying question. We're going to see that at that meeting in Switzerland also in a week or two, is what is the future for Ukraine in all of this? Are we, on a trajectory at some point where rather people are going to steer Ukraine towards negotiations?
So, Ros, you're painting a picture of kind of a gradual and incremental support from Europe and from NATO allies for Ukraine. When it comes to the financial backing for this country, there's the G7 meeting. The leaders are going to be meeting there again. Is there something more robust they can come through with when it comes to financial support for Ukraine?
Well, the finance ministers met recently and they talked about this idea of how they can better use Russian assets that have been seized since the start of the war and the interest, the windfall profits from those assets to support Ukraine. And so they made a presentation that will go to the leaders at that meeting of the G7. Again, it's about the mechanics of how you do that. How do you get all that interest that's sitting there being earned on these Russian assets, including at central banks or whatever, and how do you send that to Ukraine as a form of a loan, tied to those underlying assets? But there's all sorts of complicated questions around that, including the fact that it's dependent on sanctions continuing against Russia, and those sanctions have to be re-upped periodically, for example. And so there's a lot of trickery around that, and how do you sort that out? But definitely that's going to be on the table, and that would be about fundamentally supporting the Ukrainian economy also through the difficulty of several years of war already.
Thanks, Ros. Great stuff. Rosalind Matheson. It's interesting they're sending older kit. Does that kit get replaced here in Europe? How expensive is that kit to replace here in Europe? The Mirage 2000 is a relatively old aircraft. Obviously, the Rafale has superseded it. What comes next? I think in terms of spending to replace those 2000s is really interesting. And that goes maybe to the heart of what we're about to talk about next, which is elections underway at in the European parliamentary elections. It's a vote that will help set the policy direction for the EU for the next 5 years. Let's go to Brussels. Bloomberg's Stephen Carroll is there. Stephen, just kind of folding in the security story, there's a lot going on in terms of these elections and kind of how Europe continues to respond to some of the threats it poses. Just walk us through what we should expect. What is the likely outcome of these elections and what it's going to mean in terms of the direction of travel?
Well, look, the war in Ukraine is the central issue in these votes if you're looking at a pan-European level. And the question that the European Union can try and seek to address is around the issues of the defence industry. That's where it has the most competency because member states tend to guard control over their own defence policy. So a question that we'll be looking to try and answer when we see the makeup of the new Parliament on Sunday is how much impetus will there be, how much support will there be to ramp up defence production in the European Union, joint procurement, building the machinery so that Europe has its own defence industry that can produce at a level that can guarantee its own security. These are questions that the European leaders tackled in just a month after the Ukraine war began, but it's still a question that needs money allocated to it, and allocating money is something that is central to what the European Parliament's role is. That's just one issue. Guy, think back 5 years ago, climate was the dominant issue in the European election. This time around, it's a question of how much of the Green Deal, the world's most ambitious climate policy, could be rolled back by the results of these elections. There are parties out there who want some of the promises to make Europe carbon neutral to be rolled back, to assuage some of the protests that we've seen, particularly from farmers across the bloc as well. So that's something else from a policy point of view that we're going to be watching when it comes to these events. It's also worth remembering we're looking at elections in 27 different countries across the European Union. We're also getting a temperature check on how governments are performing. These elections are often seen as being somewhat of a midterm for many performing governments as well. In some countries, we're seeing them as a referendum on the ruling parties too. People don't tend to vote in the same way in the European elections that they do in the national elections, so we can't draw too many conclusions from that. We do seem to see a little bit more drifting towards extreme parties in these elections, and for that reason the performance of the far-right parties is a particular focus.
Yeah, and you raise the questions that have been asked in Europe and the fact that the answers are relatively embryonic still. Where does that leave us? Your assessment, Stephen, of the kind of key policy challenges that the new and reformed and refreshed EU after these elections will face?
Well, aside from the question of defence in Ukraine, which is something that is central to so many of the party platforms, they want to support Ukraine, the question of how and how much money is central to that. We've talked about climate policy, but then there's the long-running issue of competitiveness. How does the European Union compete in a world where you have the Inflation Reduction Act in the United States and you have Chinese subsidised industry producing products that come into Europe as well? We know that's a problem that is tackled at a European issue. We have that question over whether or not there'll be an investigation into the subsidies for Chinese electric vehicles, for example. But also you are going to be looking at issues around how much of the two reports we're getting on making the single market work better, reducing regulation of common coal, perhaps easing some of the rules around mergers as well, and the Capital Markets Union, something that we spoke to the Eurogroup President Pascal Donoghue when he was with us on Bloomberg only a couple of weeks ago. He said that the makeup of the European Parliament will not influence the progress on the Capital Markets Union, something that we know has been a long-running project in the EU, does seem to be making progress, and that's an issue that could give the European economy a real boost.
Stephen, we're looking forward to the coverage as it progresses. Thank you very much indeed. Stephen Carroll joining us from Brussels ahead. Well, we've started the process as it continues this weekend. The EU election so pivotal in terms of the direction of travel. Tom, it's worth focusing on the ECB. Let's get back to the ECB. Christine Lagarde yesterday decided she wants to put her poker face on. Others have decided that they are going to follow suit as well. The Bundesbank, Joachim Nagel. The ECB isn't on autopilot on interest rates. The German economy is recovering. Then you've got the Slovenian central bank governor. We can't predetermine the path of ECB interest rates, so that they're all singing from the same hymn sheet, hiding behind their poker faces.
Latvian's central bank governor came out earlier as well, at around 6:30 or so, echoing the same kind of message. Of course, these are members who are more traditionally on the hawkish end. They are echoing what we heard from Christine Lagarde yesterday. Does that mean that they have won the debate within the halls, the hallowed halls of the ECB?
Yesterday felt like a compromise. The problem with yesterday was that they'd so heavily pre-committed to June. If they hadn't delivered this month, that would have been a massive shock. But now what? How can you... Does that now look like a policy mistake? If you leave it too long before the next cut, this June cut could stick out like a sore thumb.
You're still in restrictive territory on rates. Are we overreading this? I mean, maybe it's a 25 basis point cut.
Maybe.
You're still at 3.75%. They hold for a couple of months, remains in restrictive territory.
But this is a big deal. they've cut before the Fed. They've never done that before. This is a monumental moment, and as a result of which needs to be taken seriously. The ECB, though, does have a history. It has in the past made policy mistakes where it's done one thing and then had to reverse policy very quickly. Now, this doesn't feel like we're in that territory yet, and maybe that's exactly what they're trying to avoid.
I think what you're getting to, and you haven't mentioned the word yet, but what this points to, because we can accept that it remains in restricted territory at 3.75%, is the credibility issue.
Yep.
That's what you're nodding to, essentially. That's what you're pushing on. Is there a credibility question for this ECB that flagged at the beginning of this year they're going to cut in June, and suddenly they go data dependent again?
And suddenly, yeah, because the data is now pointing more to a US model than
as
inflation.
They revise up those inflation forecasts.
Absolutely.
Coming up, we are going to be watching stocks to watch. And, of course, the central bank policy ties into this, doesn't it? European stocks have had a pretty decent run so far this week. We're going to zero in on European chip stocks. That's after TSMC over in Taiwan posted a May sales figure that saw an increase of 30% year on year. And guess what? It's all about AI once again. More on that next. This is Bloomberg.
You need to have an AI game plan. In fact, in the SaaS era, which really got started in 2010, a bit before that, we used to say that every company needs to think about becoming a software company or their digital side of their business. Now we say that every company needs to become an intelligent software company. And if you look at the buyers of our companies, all the exits we've had over the last 18 months, many of them are industry buyers that are looking to transform their companies through software.
That, of course, is Orlando Bravo, the founder of Thoma Bravo, co-founder of Thoma Bravo, speaking to Danny Berger at the conference in Berlin. Super return, some great coverage coming out of that, talking about how every company needs to be an AI company right now. We'll come back to that thing. We need to talk more about TSMC. We'll do that in just a moment. The read across into European chip stocks this morning could be quite interesting. Not substantial, but at least interesting. Let's talk about the bigger picture story, though, and what is happening today. It is payrolls day over in the United States. 7:30 a.m. Eastern time is when that data is going to drop. Survey number is 180. The whisper number is 160. The market feels like it's set up maybe for an upside surprise, therefore, on that data. The bond market has had a sensational rally this week. Does that come to a crashing halt at 7:30 a.m. Eastern time this morning? Let's find out. We're joined now by Markets Live Executive Editor Mark Cudmore. What do you think?
Guy, I think you've lined it out perfectly. I think we are set up for an asymmetric reaction to the top side if there's a bit of a beat today. I just think we've had a great run in bonds. I think, as you said, the whisper numbers for software again. We've kind of got into this momentum trade in longs. On the future side, we've seen kind of shorts move to longs there. So I think, you know, without having any particular insight on the number itself, I think there's likely to be a bigger reaction on a topside beat than there is if there's a miss to the downside in terms of yields. That said, I don't necessarily think we're going to change the narrative in yields. I think the backdrop still remains the same. We've got about two cuts priced for the Fed for the rest of this year. I think that's about right. I don't see us pricing in much more, so I think we're bottoming out in yields here in the short term in the front end. And I still think, I've been wrong on this repeatedly, I still think that ultimately to the second half of this year, the curve should steepen at some point, but there's no sign of that just yet.
So what do you do with equities this week? So if we're bottoming out on this yield story, which seems to have had an impact on the equity story, is this also the time to maybe flip the equity story, at least tactically short term?
No, I don't think so, actually. I think equities will continue to do okay for the next couple of months. I think that the backdrop, the macro picture is still good, and we've got through earnings season. And so from the bottom up, the AI bubble, and I use the word bubble intentionally. I think it's early in that stage. It is not set to pop anytime soon. All the earnings guidance show that there's still a lot of money pouring into this sector. So I don't think there's a bottom-up disruption. And I think from the top down, the fact is central banks, Canada and Europe showed us this week, central banks have a dovish reaction function. They're keen to cut given half the chance. And therefore, I think if yields bounce, sure, short term that's a little bit higher for stocks. But next week, stocks will just go higher again because overall rates are not tight in the US relative to the strength of the economy. They're not particularly restrictive policy in the US like there is in the Eurozone.
Mark, let's take it to your favoured wheelhouse and your old stomping ground of FX, your continued stomping ground of FX. The Mexican peso, whether or not, and this is a question that Guy Johnson, just to give him some credit, some modest credit, has been raising since the start of this week, maybe before, as to whether or not actually the politics is more important than maybe some central bank action and the market's inability to get their hands around the political ramifications. We have a chart, the Mexican peso. I know you're all over this story, Mark. Down 5% this week. Reforms being announced from the new leadership there. Moderna, the party that could undermine, that's the fear, some of the institutions in Mexico. And the Mexican peso taking a hit. Mark, what is your take on the political risk around FX?
I think political risk is clearly very important this year, but I think the real one is the US. I think for Mexican peso, I don't think the fundamentals have changed tremendously. What we've seen here is that implied volatility measures have risen significantly around the Mexican election and the fact that we've got the US election. So both those factors means the whole curve of implied volatility for the Mexican peso have risen. And that's really important because essentially what every carry trader looks at is not just the interest rate return, but interest rate return relative to volatility. So that ratio has just collapsed. So suddenly, Mexican peso from most of the last year or so, almost always looking like the best carry trade in the world on a carry to vol ratio, is now on a carry to vol ratio looking quite middle of the pack. Not terrible, but not particularly exciting. And that's why all this stale position has been cleaned out of the Mexican peso. Because the US election follows the Mexican election, it means that volatility is not going to collapse back to where it was. So Mexico's going to stay slightly hindered. But it's not suddenly turning a negative story. There's no reason to suddenly become bearish on Mexico. People should have taken profit on the trade last month. If you didn't, you've suddenly got a wake-up call. But there's no suddenly reason to get aggressively bearish. You just retrench now, find somewhere else.
Mark, the elections we've seen this week, the last few days, have been a wake-up call that you need to pay attention. India is an obvious example. Mexico is another obvious example. But the gorilla in the room is November and the US election. Is the market going to apply the same kind of we'll wait till it's important, it's not having an impact yet, but it we'll price it in later kind of trade to that US election? Or does it come earlier this time because we're learning the implications, the significant policy implications for markets from these other examples? I'm just kind of wondering whether what we're seeing now changes the market's attitude towards November.
Yeah, it's a great question. And I have been kind of in the bias, the way that you're kind of thinking there, Guy, that maybe this year we priced it in earlier. Before, you kind of ignore the US election to at least August. Now, maybe this year, I thought maybe you do it earlier. But just this week, my thinking on this has been evolving to actually go, maybe not. I think there's such partisan divide in the US that, you know, people are trying to kind of almost ignore it and kind of have their own bias until they're forced to. And I think also the division in their policies is less extreme than before. Neither of them are going to bring fiscal control in. So there's going to be that fiscal concern, that fiscal spending as a tailwind, but also fiscal concern for the Treasury's curve is going to remain very, very strong. And the hard line on China, the isolationist stance, those are pretty much the same. Yeah, sure, there's subtlety on spending and taxes, but overall, I think Bill will wait till after the election, and then I think it might be a bit of a wake-up call for the US exceptionalism trade.
OK, Bloomberg Markets live executive editor Mark Cudmore, thank you very much indeed, as ever. Remember, you can get up-to-date analysis and insight from Mark and the rest of the team, but mostly Mark. Just go to MLIV Go.
There's lots of other... He's got a great team.
He has a fantastic team.
He's got a great team.
He has a fantastic team. Just kind of big him up a little bit after he spent 5 minutes with us. They have a great team, so check it out for the analysis and the context. Let's get to your stocks to watch then. TSMC over in Taiwan. Just a reminder of the strength, and Mark touched on this, the AI story. The strength coming through for TSMC. You cannot manufacture NVIDIA chips without TSMC. They are the sole manufacturer of NVIDIA's GPUs, of their AI accelerators, and they saw in May sales increasing by 30% year on year. So look for the European chip story, particularly ASML, because, again, this is a symbiotic relationship. You cannot have NVIDIA's chips without TSMC. TSMC can't produce the top-end chips without ASML's extreme ultraviolet lithography machines. So we will watch ASML, that's already had a very solid week, of course, for any reaction to that, and other European chip makers. Also moving on briefly, UK home builders, there's a line coming through that the Labour Party, that of course is polling, 20% ahead of the Conservative Party, ahead of that election July the 4th, if they were to win, with the caveat, of course, would extend support for first-time home buyers and essentially offer something of a guarantee for first-time home buyers. So we'll see if that has an impact on some of the home builders. And, of course, the BOE expectations are part of that story as well.
I think the Apple story Monday is going to be interesting. Just in terms of taking the TSMC story, what are we going to learn from Apple in terms of its new chips?
Really important.
And how it's going to apply
its AI strategy.
Yeah, exactly. That's going to be the big story Monday. We'll talk about that a little bit later on. A couple of other stocks I want to flag for you this morning. This is a German-listed company, German-based company that is based over in the United States. Take a look at the CureVac share price over the last couple of days. It has been absolutely rocketing. We haven't talked about vaccine makers for quite some time, but we're starting to see renewed interest, renewed concern around what is happening with bird flu and bird flu's ability to jump to humans. Look at the share price rally we've seen over the last few days in this company. It has a vaccine potentially that could help us out with this. The other stock I want to flag this morning is Porsche as well. Porsche, I'll leave you just to read what is on the screen right now because that makes it a little bit more alarming. Look, Porsche has made a big push, obviously, into the EV trade. The Taycan, that has been a big trade for them. They're going to be meeting with shareholders today, and apparently shareholders are basically pushing them to slow that trade down. Don't make this EV transition as fast as you currently are. If you want to take a look, you go online and look at residual values for 2-year-old, 3-year-old Porsche Taycans. They have come down really quite considerably. There is concern around that market, and shareholders are basically saying, maybe focus on the old school
engines. I can't believe I have to give you more credit, Guy. But again, you mentioned a few months back that the Porsche Taycan, because you were looking to upgrade yours, has gone down. It's gone down in value. You've got 11 of them so far. You want to add a 12th. They've gone down in value. You flagged this a few months ago.
That would be a terrible trade, wouldn't it? That certainly. And anyway, I'm not saying they go back to the old air-cooled engines, which would be nice, but maybe that's a trade that we should watch out for as well. European markets cautious into the payroll data later. This is what we look like going into the open. That's next. This is Bloomberg. Morning, Friday the 7th. We're about 2 minutes away from equity trading here in Europe. I wouldn't expect fireworks first thing this morning. The reason for that, it is payroll day over in America. 7:30 Eastern is when that data will drop. That is likely to be the catalyst. But this week we've seen a big bond market rally. If that reverses, does that have an impact on equities? Anyway, Tom, people are a little cautious going into that data.
We're looking at the wage earnings component. Within that, you flagged that the unemployment rate as well is expected to come in at 3.9%. I wonder if you get a 4% or above number on unemployment, does that change the view of the Fed? Deutsche Bank putting out a note pointing out that this would be historical if you got another 3.9% in terms of the run of unemployment below 4%. The longest run is what Deutsche Bank are saying since the 1950s in terms of sub 4% unemployment.
My question is, does this data move the dial for the Fed? The Fed has made it very clear that it wants to see a series of data. We've seen a series of speakers coming out indicating that. So does it really change the narrative? I suspect what will happen today is that we've priced in 2 cuts this year. So the swaps market will get really excited and it'll start maybe saying maybe we get more than 2. But I think the barrier for that is really high. 180,000
is the estimate. You've been pointing out that the whisper number is below that. Jay Powell, the take from some would be he leans more dovish on this. If he starts to see a crumbling labour market, he is has a greater intention to go than maybe some of the other members.
We should probably talk about some of the single stocks we're going to be watching here in Europe this morning. Keep an eye on SAP. It had a good run yesterday. Apparently more people want to join its early retirement scheme. Keep an eye on that. I'd keep an eye on some of the defence stocks as well. Keep an eye on names like Saab, maybe Dassault as well, that makes the Mirage 2000. Keep an eye on some of those names too.
Because the handoff from France of those Mirage to Ukraine will mean there will need to be some kind of replacement. You would expect. They wouldn't do that without having that in the pipeline. We count down 2 seconds then to the open here. And as Guy was saying, not not expecting fireworks, given that there will be a bit of a holding pattern ahead of that non-farm payrolls data, the jobs data in the US. But we will be scrutinising the house builders here in the UK on the back of the news around some Labour policies, Labour Party policies, and as well the chip makers, TSMC, just reminding us of the demand that continues within the AI space and whether that has a read across for the likes of ASML. Currently then checking in on the FTSE 100, modest gains of about 0.1%, 8,293, so building on the gains of this week so far. Over in Italy, the FTSE made about 0.4, and you're seeing very modest gains over in France, up 0.1% on the CAC 40.
Let's just deal with some of the stocks that we are. UK house builders. Are we going to see some rally? Are we going to see a rally come through there? That'll be interesting to watch out for. I think early indications are probably yes. We are going to see maybe that trade coming through. Husqvarna is in terms of the percentage gains, is the lead in Europe this morning. But in terms of the points, to your point, it is ASML.
It's technology, ASML, another lift there. And, of course, this is the company that provides the tech that is needed by TSMC that, of course, dominates in the foundry space to be able to churn out those NVIDIA chips. So ASML benefiting on the back of that. It looks like Infineon is also getting a lift, ASM as well. So a number of those tech names. Infineon up 0.7%, BE Semiconductor. These are modest gains. ASML, again, up currently 6/10% so far in the session. We'll see how that builds, if it does. So modest gains, but it's had a very strong run-up in this week. The gains, of course, year-to-date have been decent as well.
What I think is interesting is that Schneider, which is seen as a sort of AI trade, they make the kit for the grids that kind of go into the server farms. That's a little softer. Asia Brown Boveri, ABB, Asia Brown Boveri, is also soft, get that right, a little bit this morning. So it's interesting that ASML is up, but some of the other AI trade stocks here in Europe on the technology front are a little softer.
Darktrace, which, of course, took its home in the FTSE 100 yesterday.
Not for long.
So question marks about that, given that Thoma Bravo has agreed to take that company over. Darktrace is down 0.2%. Computer Centre's down around 2%. So there's some losses coming through from the software group Sage, but not much, just 0.1%. Across the FTSE 100, then, we've been looking at the home builders. Interesting, the miners as well. There's a little bit of softness coming in through some parts of the commodity space. Anglo-American down 0.9%.
We're making this all sound very exciting, but it really isn't.
I think Maria Weidmana is going to re-inject the excitement into this conversation.
We're waiting for payrolls. Yeah, she's chuckling.
Hi, Maria.
Hello.
Thanks for joining us. You always bring lots of energy that's going to, outstrip the pessimism, the doldrums being brought to play by,
we're just waiting. We're waiting for 7:30. We're waiting for 7:30 Eastern. We need a catalyst, and that's going to be the payroll number.
And Guy Johnson, by the way, is also on tenterhooks about Roaring Kitty and the live YouTube.
That's coming later as well.
That's also another catalyst. Maria, thanks for joining us. Where do we stand in terms of this equity market? Are the drivers there to keep this rally going? And do we need to dial back our expectations, even if this looks sustained? Do we need to dial back our expectations in terms of the kind of upside that we've seen year to date? Can that continue, or is this a more modest grind higher for stocks?
Well, it really depends where you look. So there is one part of the market that very excited. Usually excited by something. So tech story is fantastic. It's doing well.
You're not an outlier there, Maria.
Well, I don't know. Like every time I go to a client meeting, people ask me, when is it time to sell? When is it time to sell tech? When is it time to go to small caps? When time to go to value? When time to go to Europe?
You
when
hate
do I
small
get...
caps.
Absolutely. With passion.
Yeah. So with a passion at one end, mega cap tech stocks, small caps, the exact opposite.
So what is your response to that? It's a legitimate question. At some point, the capex is going to be strained by these companies. The macro environment, of course, is going to be part of the factor, the yield environment, the interest rate environment. What is your response to those who say, look, valuations are looking a little rich? When is the exit from this trade?
So what is helping tech? Tech has, with AI story, it has been able to find a source of revenue that is almost independent. I mean, it can't be completely independent, but almost independent from business cycle, from interest rates, right? So we see strong demand for top line, right? So, I mean, today's news, we want more chips. Everybody in the chain need to produce more. So there is a top line story. And margin story is strong because tech has done its very hard work in the last couple of years. It cut costs, it cut headcount. It's not particularly sensitive to higher interest rates in the sense that balance sheets are fantastically strong. So top line is strong, margins are strong, so tech is making money. That is not true about the rest of the market, right? The rest of the market seeing a lot of pressure from higher interest rates, from higher labor costs, margins are getting squeezed, profitability is much, much more difficult and much more sensitive to what central bank is doing. So tech is kind of in a bubble of itself in terms of its profitability, right, its earnings. So that's a great story, and I'm not entirely sure we're close to that popping, especially if we worry that central banks are going to maybe be a little bit too slow in terms of cutting interest rates, or the impact of interest rate cut will take a while to go through. So economy is too slow.
So you've got the tech story and you've got the rest of the economy story. You talk about it being a chain. It feels like it's more like a cycle at the moment, though. You've got big tech wants to buy AI chips, and you kind of go round the cycle. ASML, kind of NVIDIA, it kind of goes round and round and round. It feels like kind of we're running around. If there's a crack in that chain, how quickly does it spread through the chain?
Yeah, no, that's a fair point. But what is really interesting to me is that, I mean, this AI excitement is capturing imagination from companies all over the spectrum, right? So I think it's really interesting that AI has been the most mentioned term during the earnings season, right? So companies from, I don't know, healthcare, industrials, material, any sector, they all talk about AI. But more than margins, more than earnings, more than economy.
When I ask CEOs, you talk to a CEO and you go, yeah, you want to talk about AI? And the follow-up question is, have you figured out how to monetize it yet? Do you actually know what the business plan is yet? Do you really understand the impacts it's going to have on your business? No. So the big question to my mind with AI is, and the question we still don't have answered yet, is kind of the ultimate monetization, the ultimate use case, how long that takes and how easy it's going to be to incorporate into business cycles. Until we answer that question, are we certain that this thing is going to... Because NVIDIA's kind of price implies an awful lot of very good gains over the next few years, and the ability to keep EPS moving as well.
Yeah, I think the key maybe is a third question to those CEOs is that, okay, so you want to understand AI, you want to monetize it. You don't really know yet
how to do it.
But are you going to find out? Are you spending money to find out? And I think the answer to the third question is yes, they are spending money because they worry that their competitors would. Right?
Yep.
So I think because people are still want to find out, still want to monetize, they're still excited about it, so they are spending money on it and will continue to spend money, at least for kind of foreseeable future.
At least for the foreseeable future. When it comes back to the macro and the ECB, and this is something we're debating, whether or not the cut that came through yesterday and the fact that they haven't given guidance on future cuts, is that a headwind for European markets, or are the elements there in terms of the growth story to be able to continue to give the upside, corporate margins, corporate earnings can sustain, even as we don't get clarity on when the next steps are for this ECB?
Well, I have to say I'm very old-fashioned about my investing. I want companies that grow. That's why I like tech and worry about small caps. And I think Europe is, I mean, I wrote a note, I gave them 3 Bs, bleak but better. So, I mean,
there's the buyback story, there's a dividend story.
Yes, absolutely. And I think
there's a valuation.
And there is valuation story. But if you think about earnings, so what happened, why people talk about earnings? So Q1 earnings surprised, right? So they were expected to go down 10%, and they gone down 5%. And I think people are excited about, okay, -5 is better than -10, but still minus. And every single sector except for except for financials in Europe have seen earnings decline. I mean, that's not. I mean, I'm not excited about investing in those companies. I'm more excited about investing into companies that can grow and can protect their earnings when the economy slows. And that's not Europe.
Does the rally broaden out?
No. So that's simple answer. But I mean, look, S&P is up, what, 12-13%? Small caps, couple percent. Rest of IFI is what, 5-6?
So I buy the S&P, not the equal weight.
Not equal weight, of course not. I mean, you buy mega cap if you can. Buy NASDAQ.
But you don't, because I've seen people talking about moving into the equal weight.
I mean, mean, yes. I mean, if the idea is that, okay, they're cheaper, they underperform, they should mean revert. But why? I mean, they underperform because they're better companies, they grow faster, and that's what market wants. When we're about to go to slow down, you want to be in market leaders. You want to see companies that perform, and that's what gives momentum. You're not going for like reversal. You go to reversal when we're at the bottom of recession and things about to improve. We're not at that point yet. We're still getting into things getting worse, and that Fed will cut, and then cut more, and then we start recovering. So that would be a small cap trade.
Aside from the AI trade, which, as you say, it's its own little kind of universe going on over there, the US consumer still seems to be quite strong. And that seems to be the trade that has given the US impetus. Yep. I spent the beginning of this week talking to a whole load of airline CEOs. I had Bastian, Scott Kirby over at United. They're all talking about the fact the consumer continues to spend aggressively. The TSA data points to that in the States as well. Ticket price, a boarding card are still being scanned at a huge rate. What is that? How healthy is the US consumer? People talk about this sort of K-shaped recovery. Some are doing great, some aren't.
Yes, yeah. I mean,
when does the K meet? Does the top come down or does the bottom come up?
Well, I mean, K-shape we talked about during COVID. So, but I think in the US, because of such huge inequalities, there is a very different experience people have from higher interest rate. If you're an asset owner, I mean, higher interest rate actually not bad for you. You have your house, you don't have to pay higher mortgage, you don't need to borrow money, and you make money on your savings. If you are maybe like in the beginning of your career and you need to buy a lot of things, you are much more interest rate sensitive, right? Yep. So there is a group of people who are doing quite well, and probably demographically it's older generation who already kind of amassed a lot of wealth. So they're feeling strong, and actually I think it's really interesting the airline example you're bringing up, because the older demographics, they spend more money on services other than goods, right? Either healthcare, or they're fortunate to be in good health, they spend money on travel, on leisure. So they're going on trips, they're spending money on services. And maybe younger people, beginning of their careers, they spend more money buying goods.
Where does that take you on the consumer trade then? You got the essentials, the non-essentials, luxury. How do you've outlined, and there's a lot of evidence that backs that up, that differentiated picture when it comes to the US consumer. How do you trade along that?
I mean, I think it's a little bit company by company, so you find who is selling to that demographic, to richer demographic. I thought what was interesting is that, so we see, as Fed actually, I mean, probably ties into macro, as Fed kind of delaying cuts and waiting for more evidence, we're seeing a bigger part of the economy going from, actually, I'm very comfortable, I'm doing well, to slipping towards things are getting challenging, I need to refinance my mortgage, I need to update my loans. So you see kind of this dripping down this into more difficult territory. I thought it was really interesting. Walmart said that they had one of the biggest increase in sales to middle-class people. So I think that's potentially a trade where people are trying to find kind of better deals, and those companies are benefiting.
Do you still like cash?
Yeah, because I do worry that it would be very difficult to avoid recession. So, yeah, cash and tech.
But you've been talking about that trade for a long time.
Yep.
The longer central banks presumably leave rates on hold, the longer that cash trade continues to make sense.
Yep, absolutely.
And what would it take for you to get that cash deployed at this point? How high is the bar? How much certainty would you need to have to deploy some of that money?
So I think I mean, a lot of it is deployed into tech. So it's not like we're sitting on piles of cash, but that's a bit of recession protection. And as we were talking earlier, I think like value trade is coming, small cap trade is coming, just not yet. So I think more evidence of we are getting into like weaker data.
What would it take you to get into small caps? What do you need? You need to see a recession, right?
I need to see a recession, yeah.
And when do you think that comes?
Maybe towards the end of this year, beginning of next year.
Okay. So we're
getting there.
we're getting there.
Unfortunately.
Yeah, exactly. Maria, nice to see you. Have a great weekend. Maria Veitmana joining us, Head of Equity Research out of State Street Global Markets. Thank you very much indeed. Let's take a look at the core six here in Europe, see what's happening with the big trades around the continent. ASML, obviously one trade that we've been watching in light of what we've seen, and Tom's been bringing us this with TSMC. So ASML is up like a reasonable amount. I saw the initial calls this morning of being only sort of 0.2, 0.3 higher, but it's actually up by a full percent. It's interesting that Schneider is not, but luxury is having a better day today. in the LVMH story. Tom has issues with whether or not these companies produce useful things.
I just have issues with your collection of Birkin bags. That's all. That's all.
I parked them next to what am I buying this morning?
Yeah.
Ferraris.
Yeah.
No, Porsches.
You've got 12 of them. ASML. So I'm just doing the year-to-date on ASML because you're right. Look, it's a bit of a better day than maybe some had expected. Of course, you know, you've seen strength year-to-date. The year-to-date picture is up 40% for ASML. So you continue to build on that. And again, they have this monopoly. They have a monopoly on the highest-end lithography machines. No one else produces the top end that are needed for 2 nanometers and below in terms of the size of these chips. So ASML benefiting once again today. It's kind of closing up like 0.9% right now. We're looking at the real estate stocks as well here in the UK. The stocks around the house builders, of course, a little bit of a lift coming through for the likes of Barratt Homes. There's a policy announcement, it seems, from the opposition Labour Party around potential support for first-time buyers. So we keep an eye on that. And again, the chip story in the read across in Europe on the back of the growth that TSMC saw in the month of May, up 30% for TSMC, and that is lifting, as we discussed, ASML.
Defence stocks. Interesting in the light of what we've seen in terms of the French deciding that they are going to provide the Ukrainians with some Mirage 2000, so we'll keep an eye on that trade as well. We should probably talk about Mike Lynch. Big day yesterday. Yeah. Huge day yesterday. We'll talk in more detail about what's coming up with this story. But Mike Lynch, in a court in San Francisco, the jury acquits him. This is staggering. This is a 10-year story that has been in the making. But we'll come back to that. We'll get you a bit of analysis on what is happening with that trade, with that story next. Not guilty. This was a huge fraud trial. Anyway, we'll come back to that in just a moment. This is Bloomberg.
The charming British High Street, or Main Street if you're American, with its cobbled streets, picturesque pubs and cutesy bakeries. But there's an uncomfortable truth lurking behind the storefronts, because a lot of these stores are not owned by independent shopkeepers or even big multinationals. Instead, they're controlled by private equity investors.
So essentially, you could buy a really massive company and load it up with debt to pay for your acquisition of that company.
In fact, private equity has flown into the UK at an unprecedented rate since Brexit, hoovering up scores of high street names such as Burger King, New Look and Pizza Express. Now, as the UK adjusts to new economic realities, the private equity boom could pose a problem for the future of the British high street and the millions of people who work on it. Because most private equity is dependent on one thing: debt.
So when these deals go wrong, it can have real-world impacts. So it can mean higher costs of goods for consumers, and we can also see jobs lost.
The Bank of England has been worried about increased private equity ownership of British companies. They're worried about increased debt levels, and they're worried about the impact it will have on the British economy.
It's a bit of a theme coming out of that package and also from the Super Return Conference that's been taking place in Berlin. You want to get more? There's plenty more to be had on Bloomberg. That was obviously a Bloomberg Originals mini documentary talking about how private equity ate Britain's high street. Go online, find more of that kind of thing, and the production's great. It's really worth paying attention to. Anyway, I don't know how to pivot to the next conversation, but I'm just going to do it anyway. This is a much more serious issue and a surprising issue in so many ways. A jury has found British tech tycoon Mike Lynch not guilty of criminal charges. This was a criminal case. This relates, obviously, to the staggering loss that basically HP had to take on board. It's also a staggering loss for US prosecutors who had anticipated that they would be seeing him found guilty by the jury. Hewlett-Packard, remember, bought Autonomy, the software startup that Mike Lynch founded for $11 billion 13 years ago. He said ultimately he was the scapegoat for that deal that had gone bad. Let's get more. Jonathan Browning joins us to assess the situation. This is a big surprise.
It is. The US has an extraordinarily high conviction rate. If you end up in front of a US judge, the chances are you are going to prison. And so not only has he overcome that hurdle, but he's also overcome the hurdle, this intense pressure that has effectively been been pursued by HP for over a decade. And then there was a case in the UK, a civil case, where a British judge considered a lot of the same issues and came to a different conclusion. So it's an enormous surprise.
Well, that's really interesting, isn't it? The civil case and the case in San Francisco and how the two results diverged. What does it mean for HP? As you say, they've doggedly pursued this case. How damaging is it or not for HP?
They've always claimed that they were the ones defrauded, that they were the ones that paid an enormous amount of money for the second largest software company in the UK, a huge deal, and then had to take the loss that came with it when they discovered that it was not quite what it seemed. Now a criminal judge, a criminal court, a jury, has come to a different decision and said, well, actually, we don't think that Mike Lynch has played a role in any kind of fraud at all. It leaves a huge question mark for HP because they have been putting a lot of pressure, and particularly also on the US, to pursue this case in the US as well as in the UK.
There is a big question about whether or not the UK should have sent Lynch in the first place, should have allowed the extradition to have taken place, given, as you say, the precedent that exists, that there was a huge likelihood that he would be found guilty. How do we see changes in the way that UK and other jurisdictions will treat similar cases in the future, do you think?
So David Davis, who's been an MP who's been a long-time supporter of Mike Lynch, was actually very quick off the blocks to say that this actually is another opportunity to look again at effectively what he says is an unequal treaty. He pointed to the case of the US diplomat who managed to leave the UK without a prosecution. And the question now is whether or not there is enough momentum behind it in the time of an election when there's an awful lot else going on. But he was very quick to say that there had been overreach by the US, and the UK and British business people particularly had suffered as a result.
We'll see if the next government looks to change that. And you're of course alluding to the US diplomat and the links to a fatal traffic accident, in fact, here in the UK, and the uproar that caused domestically in the UK.
You think about Starmer's history as well. Prosecution.
Chief prosecutor, of course, for the UK, if he becomes...
So in theory, he has some understanding of what is going on here, and therefore would be well placed, presumably, to take a different view, or maybe a changed view from the UK government.
Yeah, if he wins on July the 4th, which remains, of course, a big if. Jonathan Browning, thank you very much indeed for the latest on what is a significant turn of event, of course, for the founder of Autonomy. Mike Lynch saying he's going to come back to the UK, come back to his family and get back involved in the tech sector here. He played a huge role in the tech sector about a decade ago, of course, having being the head of the second largest tech company in the UK.
Yeah, he talks about the fact he's basically lost a decade of his life.
It's personally, absolutely huge. Darktrace is an interesting company, of course, that he was foundational as well in forming that company, as we've said, now listed in the FTSE 100 and is being taken over by Thoma Bravo. We'll see what role he plays in the tech space here in the UK. That's going to be interesting to watch as the fortunes change dramatically for the upside, of course, to Mike Lynch, formerly of Autonomy. We have some live pictures, I believe, of the Ukrainian Prime Minister Zelensky meeting. You can see him there live. This is Paris, where he'll be meeting with French President Macron. This, of course, after Macron promised those Mirage aircraft to be delivered at the end of this year. So he's meeting the defence minister. He met with Macron yesterday.
So this is the Ukrainian president meeting with the French defence minister. Yes. I think he's also going to be meeting the US defence minister as well a little bit later on, defence secretary a little bit later on. Plus he's going to be addressing the French National Assembly, which I think happens at the top of this hour. So he's going to go from here potentially to address the National Assembly. So we'll bring you those pictures as we approach the end of this hour. But these are live pictures coming from France right now. Up next, we're going to be discussing the European elections. That is a big feature of the landscape this weekend. We have an interview coming up with Marcus Breyer, Business Europe Director General. What does business want from these elections? We'll find out next. This is Bloomberg. Welcome back. You're watching Markets Today. We are 30 minutes into the equity trading session. I had to check because, to be honest, nothing's really happening. We are at a headline level, index level. We're a little soft. We're down by, 2.3% across most main markets this morning. Waiting for the catalyst. That comes at 7:30 Eastern Time this morning, 1:30 UK time, 2:30 CET. That's when the payrolls number will drop in the United States. There are things happening, though, here in Europe, more on the political front than maybe the economic or markets front today. European elections are now underway for the European Parliament. It's a vote that, of course, will help shape policy in the EU for the next 5 years. Let's go to Brussels now. Stephen Carroll standing by. Stephen, what does business want from these elections? What does it hope to see coming out of these elections?
Competitiveness of question of how Europe competes internationally, that question around competitiveness very much in focus in these elections as well, because of course the performance of the European economy matters for all of the other important policy areas that are in focus in these elections. Things like the strength of the defence industry, responding to the war in Ukraine, addressing the Green Deal climate policies as well. If the economy isn't growing, if businesses aren't prospering, that makes achieving those targets much more difficult as well. And this is part of the picture that we've had leading up to this. There have been two important reports commissioned on competitiveness in the European Union from the former Italian Prime Minister Enrique Letta. We've had that report as well. Plenty of recommendations in those 147 pages as to how to make Europe work better. We're waiting on the one from the former ECB President Mario Draghi as well. So this is part of the conversation around these elections, and I'm glad to say we can discuss it further now with Marcus Beyer, who is Director General of the business lobby group Business Europe, which makes up 40 business and employers federations across Europe. Thank you very much for joining us to bring in your point of view on this discussion. Is enough about the issue of competitiveness being talked about in this campaign? It feels like we're looking other places for the challenges the EU faces.
Well, maybe not in the campaign, because the campaign is partly very national. But I think more and more people understand that we will need to do better next time. It's very clear, and you alluded to it, we are falling behind our global competitors. We see it everywhere in growth, in investment, in productivity growth. So it's very clear that we will need to do better next time. And I think people start to understand. And if you look at the last European Council, which talks about the new competitiveness deal for Europe, that's what we need. But now we need to fill it with life.
How much time does this new Parliament and the new Commission have to get moving on some of those plans? Europe, at a European Union level, not known for its speed when it comes to policy making.
Well, I think we'll need to move rapidly. I think we'll need to, of course, after the elections, the institutions will need to be established. But then I think we'll need to start rapidly after the summer break, because we need to send a signal to the companies in the first year that it will be worse again to invest in Europe. So we need to return the tide. And talking about elections, I think successful companies, a successful economy is the best remedy against populism.
Are you concerned about a differently composed European Parliament with perhaps more populists in it that might derail some of the policies that you want to see?
Well, I think it's clear that the extremes on both sides of the spectrum might be strengthened a bit. But I think and I hope that there will still be a sufficiently strong centre, understanding that we need to bring the continent back on track. And then, of course, there will need to be majorities, including all rational forces in the parliament. And I think with goodwill, this will be possible.
Is the answer here more European money? Does the budget need to be expanded? Do you think that's a realistic approach to get some of the policies moving and some of the changes in the way the internal market works?
There will be things that necessitate money. To bring you one example, we'll need to think about how will, just one major example, cross-border energy infrastructure be financed. But the main point is to get the investment conditions right, because it's not only about money. There's a lot of money available. If you look at the Horizon Europe, not everything is spent, so there can still be money mobilized.
Is that a red tape problem? Why there's money out there? Why aren't companies accessing it?
There's a big red tape problem, and then if we look at, we have created our campaign with the Reboot Europe. We say the computer is right. We can only do together as European, but there's a couple of bugs we need to fix. And our members tell us, we have been losing out towards our global competitors in the last 5 years. And we also ask them for the reasons. And beside the cost of energy, where we need to find answers, it's a lot of over-bureaucracy, regulatory overburden. They tell us they're drowning in regulations, and that the permitting procedures to set up an industrial plant and infrastructure are taking too long. This is where we need to get better, this is where we need to find answers. And this is, for instance, what the US seems to do better.
What's the risk if you don't have action, let's say, in the next year on these issues?
Well, I think the mood is rather in the direction of action. I think if you look at what people say, or what major players say, what the European Council has said in this new competitiveness deal, more and more understand. I think the biggest risk is that we might fail to translate into action. So I think we need to translate these right messages now, where people understand that we will need to do better, we'll need to be faster, we will need to put competitiveness on top of the list again to be successful, that we translate this into action. And I would say we need to show to the companies in the first year that it's worth to invest in Europe again. The investment flows have gone elsewhere. And this is what we need to turn around, because we want the wealth in Europe, we want the investment in Europe, and we want also create quality jobs here.
OK, and the sentiment question, key to that as well. Michael Speyer, thank you very much for joining us, Director General of the business lobby group Business Europe. Great to have you with us in studio ahead of those elections. Voting taking place, Guy, today in Ireland and in the Czech Republic. The rest of the EU member states, after the Netherlands voting yesterday, will vote between now and Sunday, and we'll have the first projections of the new European Parliament on Sunday evening.
OK, great stuff. Bloomberg's Stephen Carroll in Brussels. Thank you very much indeed. There's plenty more coming up. Stay with us. This is Bloomberg.
Over there. Welcome back. You're watching Markets Today. We are 39 minutes into the equity market session. We are waiting for the jobless data to cross in the United States. 7:30 Eastern Time is when that data will drop. It's going to be the catalyst for today's session, certainly here in Europe as well as over in the United States. Yesterday it was the ECB. Today it'll be this data, certainly, that I think probably sets the tone. This week, though, has been much more, you could argue, about politics. And we've seen this represented in a number of different forms. We've obviously been watching the elections. But this week has also been a week when we've seen Europe and the United States come together. We've seen the D-Day celebrations, June the 6th yesterday. President Biden has been in Europe all week, and he has indicated that democracy is at risk around the world, and he's making reference to what is happening in the Ukraine. The US president making remarks yesterday at the ceremony marking the 80th anniversary of the D-Day landings, where he also hailed the importance of alliances such as NATO. Now, remember that President Biden is also going to be meeting President Zelensky a little bit later on. President Zelensky, out of interest, is going to be giving a speech in the French National Assembly in around 10 minutes' time. We'll try and bring you some early parts of that conversation. So Europe and the United States have come together this week, but does that apply to the business relationship that we see across the Atlantic? Let's delve into how that is evolving right now. We're joined now for an exclusive conversation with Sarah Morgenthau. She is the US State Department Special Representative from the Office of Commercial and Business Affairs. Great to see you this morning. Thanks very much indeed for joining us.
Thank you for having me.
How easy is, how free is trade? We talk about the kind of the special relationship that exists in the geopolitical theatre. How easy is that relationship How easily is that relationship working when it comes to business?
Look, the U.S.-UK bilateral relationship is extremely strong. We're seeing that play out with D-Day yesterday and the importance of our two countries. We're seeing that play out in the Russia-Ukraine war, where we are grateful for the close relationship. The trade relationship between the United States and the UK is one of the most significant and consequential for both of our countries. And we're grateful for the close coordination and collaboration. You know, in our country, President Biden has made it a priority to really invest in our country and also for the benefit of our allies. We all lived through the pandemic, through supply chain disruptions, hollowed out grocery stores and businesses that were really having a hard time because they had been too reliant on one partner. We have seen the passage of Chips and Science Act, of IRA, of infrastructure. And these are things that we are doing in the United States that are also benefiting our allies. BAE, one of your companies, has taken advantage of the Chips and Science, I think got $35 million to expand in the United States. And we see that as a good thing for our country, for your country, and enormously beneficial.
Some over here see some of those acts, the IRA, CHIPS Act, as being protectionist. Why is that not the case? You talk about the benefits that accrue to businesses outside the United States, but there are quite strong elements built in to that legislation that requires a certain amount of production in the United States, a certain amount of the supply chain to exist in the United States. To many people over here, that feels protectionist.
You know, I just gave an example of BAE, which is a UK company, which is allowing to grow globally. We are all getting ready right now for our Select USA conference, the biggest global conference of businesses, delegations from around the world. The UK, I believe, is sending 50 companies to the United States for the opportunity to expand their companies. I think that part of this is because of the investments that we have made in our country that we see as benefiting not only our country but our allies as well. You know, the business community is knocking on our door at the State Department for things all over the world. And I am seeing great investments, for example, in Kenya. We are very fortunate to have the U.S. Ambassador Meg Whitman, who was the former CEO of Hewlett-Packard and eBay, and she has been in very close coordination with President Ruto in Kenya about instituting some reforms to make the business environment in Kenya better for the United States, better for the UK, for countries around the world. And you're seeing in that $1 billion of investment.
The Inflation Reduction Act, and it comes in combination with stronger growth, of course, in the US and the catalyst that comes through with AI, a number of compelling factors to draw investment to the US. But there is a real and substantial argument about the fact that we see executives here in Europe saying, I'm not going to invest in this factory because I'm getting subsidies that we cannot match, whether it's in Europe or in the UK, and we're being drawn to the US. You can understand that's a legitimate concern.
Yeah, I understand that's a legitimate concern. I think that you are still seeing, like I said, we've got 50 companies here, you know, coming to the United States. We're working together. Prime Minister Sunak and President Biden have worked on the Atlantic Declaration. And there you are seeing our two countries, as we have done for so long with our enduring strong relationship, tackle things like AI, like technology, like defense, like health. And so I think that there really is a like-minded view of our two countries that will benefit our business community.
On China, you can certainly make the argument that the UK and the US have rarely been this aligned on the question of China. We'll see if that changes after the UK elections, July the 4th. When it comes to the question of China, are you taking a bit of a note from the playbook of China when it comes to the question of subsidies and supports for key industries? China would say, look, you've been subsidising your energy industry, your auto industry. There was the bailout of 2009. What's the difference?
You know, I think that we have President Biden, we've seen Secretary Blinken talk about a strategy of what you would say invest, align, and compete. And so we are doing significant investment, the CHIPS and Science Act, IRA, infrastructure, you know, all of this to make it so that our companies in the U.S., the companies of our allies, including in the UK, are able to compete and are able to go to other trusted partners. I have spoken all over Europe about the importance of 5G, of cargo scanners, where it's important that we use trusted vendors that are not taking our data, that are not taking our IP. And I think that we are grateful for that close collaboration and like-mindedness of our allies, and especially the UK.
Sarah, thank you very much indeed. Really appreciate your time. Thank you for coming to this studio this Friday. Joining Guy and myself, of course, Sarah Morgenthau, US State Department Special Representative from the Office of Commercial and Business Affairs. We're going back to the decision from the ECB. We're getting some lines from ECB officials now. So we go back to the central bank monetary policy story because the Irish central bank governor, men of the ECB then, coming out, Guy, with an interesting line. It's a red head on the Bloomberg terminal, a little bit move higher in euro dollar. And the Irish central bank governor saying, we don't know how fast the ECB will carry on, if at all. It's the if at all bit. Yes.
If you take that to its logical conclusion, say we get to the if at all. Say they're one. Is he implying they're one and done?
Mark Loof from the Irish Central Bank, if at all? Was that a misspeak? Was there real weight and emphasis put on that? Not traditionally seen as a hawkish member of the spectrum, I don't think, from the ECB Governing Council. All the other speakers so far this morning have aligned with what we heard from President Lagarde. This comment pushes things in a more hawkish direction,
It certainly does, and I wonder whether that's a reflection of the conversation he had round the table yesterday in Frankfurt, and whether he's picking up on a theme that is developing there, that maybe actually this may have been one and done. Maybe we don't need to go much further. Say it gets pushed out, the next cut, beyond September. This cut is going to feel increasingly isolated. And I wonder how that is, as time progresses, how it's going to, if that's how it's increasingly going to look.
And, of course, part of that isolation, and to what extent that remains an isolated cut, will come down to what happens with the Fed, and then we get the non-farm payrolls to date. Maybe that gives us some more clarity in terms of the jobs front and what that does to Fed expectations. In terms of the market reaction, then, to this comment from the central bank governor, ECB, you're seeing yields up just marginally in terms of German two-year debt. Bunds yields up just 2 basis points. Not a huge move. A little minor pop in euro-dollar, but nothing substantial really at this point. And again, there's been a lack of volatility around this currency. A little bit of strength yesterday, to say the least. Right, 108 right now on euro-dollar.
We have been in a trading range for this pair for really quite some time.
Yeah.
And it doesn't feel like anything is going to shake it out of that. But say the ECB didn't cut much further, I wonder whether that would provide some upside catalyst for maybe certainly a move towards the top end of the range. At the moment, the market is pricing in 2 cuts from the Fed this year. Maybe the ECB and the Fed maybe aren't as unaligned as maybe we first thought or assumed, and we assumed that we would get this divergence. Maybe that divergence is converging.
And if we get other voices that build on this comment from the Irish Central Bank governor, then maybe that will become clearer. We still, of course, have a lack of clarity until the next steps. And they're making a point that they've come through with this cut. They're going to be data-dependent from here on. 3.75, of course, on the deposit rate for the ECB. And the Irish Central Bank governor, again, questioning whether or not there will be other cuts at all, Guy.
So we'll talk about this in the context of what is happening at 7:30 Eastern today. We are waiting for the jobs data out of the United States. Indications, certainly so far with the recent data, is that we are seeing a slowing when it comes to the labour market. The labour market in the United States is beginning to loosen up a bit. The survey number is 180. The whisper number is 160, so it maybe feels like the danger is that the market is setting itself up maybe for an upside surprise here. Let's get some thoughts on what is happening here and what the market setup looks like. Ven Ram, Bloomberg's Market Live, Ven Ram joins us now from Dubai. Give us the setup, Ven. What does the market look like going into this number?
Morning, Guy. I think that the market setup is going to go much beyond the headline number. We will get an expansion, and it'll be one of the many successive months of expansion that we have seen. So the markets are not likely to move on that number alone as much as it hogs the limelight. What is more crucial to the market's calculus are 2 things. One is the earnings growth. That is at 3.9%. That is not enough. That is not congruent with the Fed's 2% inflation target. And the other number, equally important, is the jobless number, again expected to come in at 3.9%. Now, the Fed reckons that you need a jobless rate of 4% or higher for this jobs market to rebalance. And until those 2 things fall into place, the headline obsession is not going to do too much to the rates. I think that rates are going to be higher for longer. If you look at the inversion in the yield curve, we have had it for almost 19 months now. That's the longest inversion in modern day history. And that tells us something about how premature the bids towards duration has been.
19 months. The longest. We were banging on about this, weren't we? And then we just got tired of it, the inversion of the yield curve. 474 on the 2-year, 429 on the 10-year. Ben, given that then, the market's pulling forward expectations of cuts from the Fed this week, marginally, from December to November. September still seems to be in play. Where do you land on that?
Well, I think that the markets are in a guessing game as opposed to divining the Fed, really. A lot of it will come down to what the Fed is going to show us with the dot plot. I mean, of course, nobody expects them to cut 3 times anymore this year. So the question is whether the Fed is going to indicate 2 or 1. And I would err on the side of 1 cut, Tom, because, there is just not that momentum. OK, the U.S. economy is softening, it's cooling and all that, but it's just not giving the Fed enough headroom to cut rates yet. We know that the economy is losing momentum, but if you look at the jobs creation, if you look at the big picture, it is still one of economic resilience. And no one is even talking about 2% inflation anymore, because now it's become the 3% is the new 2%. So if 3% is the new 2%, if we will be lucky to get one cut.
OK, lucky to get one cut. Let's bring this back to the ECB. The Irish Central Bank governor out on the tape just a couple of minutes ago. Don't know how fast the ECB will carry on, if at all. Then, if the ECB's one and done, how big a market adjustment do we now need to see?
Well, the markets, I think the markets are kind of, if you look at the German yields, German bonds have sold off this year. In a year when the ECB is supposed to be cutting, that tells you a lot about how skeptical the market is about inflation. That is just one segment of the market. If you look at the other segment of the market, the OIS market, they're thinking that we may still get, 2 rate cuts this year from the ECB, but I think that it would be prudent to expect just one. Just this morning, on the terminal, it's available. If you look at the inflation projections from the ECB, predicting 2.2% inflation next year as well. They revised it higher. So they are essentially saying we are going to miss the inflation target even in next year. And the latest we can achieve inflation congruence is in 2026. If that is going to be the case, and if you assume a neutral real rate of 50 basis points, that doesn't give the ECB too much room to cut rates, which is why I think that the Irish ECB speaker is bang on the money when he says, if at all.
OK. One cut from the ECB, one more cut from the ECB, one more cut or one cut from the Fed. Still waiting for that. What about the Bank of England, Ven?
The Bank of England is in an interesting situation, Tom. I mean, they've been wanting to cut rates. They've been wanting to take rates to what they think should be lower restrictive levels. But the thing is, I mean, they are expecting inflation to converge to 2% in the spring. And they set a lot in store by the April reading. Governor Bailey said it himself. They were expecting a reading close to 2%. And what we got was an overshoot. If in the best month, they were expecting inflation to touch 2%, and we didn't get that. And by their own admission, inflation is going to accelerate after that. So I don't think we are going to get 2% inflation in the UK anytime soon. Anyone who lives in the UK economy knows that 2% inflation is a myth. You just have to go to the supermarket to find out. That's a very big myth. So the headroom for the Bank of England to cut rates is just simply not there. If you look at services inflation, it's hovering around 6%. Is that compatible and congruent with 2% inflation? I don't think so. So, the BOE is mispriced completely out there.
Ben, great stuff. Thank you very much indeed, Ben Rahm, joining us on what is going to be a big day, certainly for the macro story. We await the payrolls data at 7:30 Eastern. We've got some great coverage coming up of that event. In terms of what's about to happen, Volodymyr Zelensky is going to be addressing the French National Assembly. I can't see the feed on that yet. I know Lloyd Austin's just been presented with the French forces in Paris, so that the US Defence Secretary is in Paris. But we're waiting for that National Assembly speech, which will be coming up very shortly. I thought it was going to be at 50. It looks like it's maybe drifted in terms of the timeline. What else are we watching? Apple's going to be a really big deal Monday, isn't it?
Really, really significant in terms of the update on its AI strategy. There's been a lot of bated breath, a lot of waiting in the wings for the detail on this. So we'll get that on Monday, a big, big story. We're going to be speaking as well to the co-founder, Steve Wozniak. Stay with us, plenty more. This is Bloomberg.